All right, my friends. So, for you folks who are worried about a recession, I'm going to share with you this article from the Wall Street Journal. The world seems to have dodged a recession for now. Strong U.S. jobs growth and other global data suggests that last year's panic was misplaced. You think? And we got from our man Greg Ip, who's been writing for the WSJ for a long time. Dateline April 5th, 2019, right after the markets closed yesterday and when we got the jobs report. I don't subscribe to the Wall Street Journal anymore, so if you want the full story, you can subscribe, or you can just go on your Apple if you got an iPhone. It'll be part of your, and I'll read this to you because I think it's actually pretty important. It'll be part of your, if you click on the app, if you click on the stocks app right there, it'll take you to the article. All right, and that's what I'm going to read to you here. I hope you can see that. So let's go over this. So Greg Ip, if the world was at risk of sliding into recession, policymakers appear to have pivoted in time to prevent it. For the love of me, man. So basically, if the government policymakers didn't do something, we would have gone to recession because the government policymakers know so much. I mean, it's just nuts. Then why did they? I can't take it. Anyway, in the U.S., the slowdown never got started. March capped a quarter in which jobs grew as fast as they did in the fourth quarter. Growth in private hours worked, a better gauge of business labor demand, actually accelerated. In the rest of the world, a rise in China's Purchasing Managers Index in March suggests its slowdown may be ending, and a modest improvement in German industrial production in February sparked hopes for the same there. Keep that in mind. The rise in the Purchasing Managers Index in March suggests the Chinese slowdown may be ending. All right, so keep that in mind. In sum, while recession fears haven't entirely receded, the panic that gripped the financial markets last year now looks misplaced. The panic was sparked by two headwinds facing the world. First, global central banks and others were dialing back stimulus. The Fed was raising interest rates 4 times while slowly shrinking its balance sheet, and the ECB, the European Central Bank, prepared to follow suit. Chinese authorities also reined in growth. Second, political risk spread. Britain's flailing effort to exit from the EU has tanked business investment, and financial backlash over budget-busting populism sent Italy into recession. So what's Turkey? Turkey's going to recession. Is that from budget-busting populism? I mean, whatever. Meanwhile, this is what I'm talking about. The Trump administration's protectionist moves, especially against China, it's a quote, wreaked havoc with world trade and global industrial activity, says an independent economist, Philip Suttle. And I'm going to look who this guy is because I find that interesting. So remember, Trump's protectionist move wreaked havoc in world trade and global industrial activity. But right before that, we say a rise in China's Purchasing Managers Index suggests a slowdown may be ending. Interesting. So which one is it there, Phil Suttle? The second set of risks persists, i.e. Trump's trade war and protectionist policies. We've been in trade war forever. We just think U.S. just hasn't engaged. But the first is receding. The Fed has signaled a halt to interest rate increases in January, helping stocks recoup last year's losses. Okay. So the whole point they're raising the rates was causing a recession. All right. So people in January say, oh, my goodness, they're causing a recession. The Fed said we're not going to raise anymore. No one in January is saying the recession fears are behind us now. But the stock market took off because we said we wouldn't have to worry about a recession as much. Yet no one was saying the recession was that bad. No one was saying that. They're saying it now, but they weren't saying it in January. And this is after the Fed had made very clear they were going to stop the raising, the hikes, the tightening of the monetary supply, if you will. The only part of the real economy to wilt under higher interest rates was housing, and it is too recovering. Since October, mortgage rates have fallen almost a full percentage point, and new home sales have risen 21%. The ECB has begun easing again, and China has reopened the credit tabs. This is the financial pornography, man. I'm just telling you. I mean, think about it. The only part of the real economy to wilt under higher interest rates was housing, and it too is recovering because since October, mortgage rates have fallen a full point, and home sales have risen by 21%. Well, when was the fears about the recession? In December and into January. See, it doesn't make sense. That literally doesn't make any sense. It's just the trade protectionist, the Trump trade protectionist wars with China, and yet China's fine. It's just, that doesn't make sense. I mean, the only part of the real economy will under high interest rates was housing, and it is recovering. The housing rates weren't that high. And secondly, they have fallen a 4 percentage point. That was starting back in October. No one was, just a frustration. No recession here. Indexes of manufacturing and services activity remain above 50. The border between expansion and contraction, you'll see, actually, it's going to be tough to see this, but you'll see the light blue, got a nice little jump there towards the bottom. It's going to be tough for me to do that. See that right there? See that nice little jump? That's a nice little jump in the world. And the U.S. is taking a little bit of a tumble. We're still above 50, so we're still expansionary. That's the top chart is the U.S. The world is taking a little bit of a jump, though. That's good. Jason Thomas, chief economist with the Carlyle Group, says much of the global slowdown appears to be a spillover from China. So did Trump trade protectionist wars change? But yet it hasn't changed at all. And now China's all of a sudden picking it up. Maybe the trade protectionist war didn't really destabilize China to begin with. Maybe it's because it's a flipping communist country. Authorities had deliberately sought to de-risk the economy, which showed up in slowing property development and flat prices. At the same time, household consumption abruptly dropped, an apparent reaction, this is in China now, to the trade war with the U.S. So why has it changed now? All right, because the Chinese are reining in credit? Okay, it might be. But household consumption abruptly dropped. The reason for that was an apparent reaction to the trade war? No, that's dumb. This, he says, spilled over to the Eurozone. Consumer spending is growing around 2% a year, says his economist. Solid for the region, but total GDP is only growing about 1%. About 3/4 of Europe's slowdown he attributes to exports, mostly to Asian countries that are part of China's supply chain. Plus knock-on effects of business investment. As China recovers, Eurozone growth will probably return to 0.5%, says the economist. The global recovery will probably pick up steam as the year progresses. With the Fed on hold, central banks in India, South Africa, Brazil, Thailand, Indonesia can cut interest rates without worrying about investors dumping their currencies. While last year's tax cut will fade, the boost from higher federal spending on the U.S. has yet to be fully felt. Indeed, says Mr. Settle, he projects that among the 7 main industrial economies, fiscal policy in 2019 will be more uniformly expansionary than at any time since 2009. All right? Yet this improved cyclical backdrop masks worrisome structural trends. Total private hours in the first quarter grew at roughly the same estimated pace as GDP, suggesting worker productivity barely advanced. That's bad news for wages, which over time reflect productivity. Manufacturing jobs have stopped growing. All right, so the jobs growth numbers don't fully address worries about potential shocks to the U.S. All right, so the U.S., he said the data showing the U.S., while resilient, is returning to a slower growth, about 2% pace that prevailed before last year's fiscal boost. All right, so the point about this, none of these guys do a freaking thing. So all the negative Nellies, the nattering nabobs of negativism, as Spiro Agnew used to say, I'm sure I'm butchering that, they were saying it's recession. Now they're saying, oh, we'll probably slow down and go back to a 2% growth. That's not recession. If you're growing inherently, it's not recession. Anyway, look, what do I know? I don't have any clue at all. Neither do you. Neither do any of these guys. And it's nuts. So the point of this, I tell you what, let's find out who my man Phil Tuttle is here. I'm just curious. I looked up Phil Tuttle, and I never heard of him, but it's interesting. Watch this. So I looked up this guy, and the IIF implodes. Already there have been 2 high-profile casualties. The IIF's longstanding chief economist, Phil Tuttle, has been fired. That's interesting to me. So what is that? What's the IIF? Look, and I don't know. I never heard of the IIF. But apparently the IIF is the Institute for International Finance. There's a lot of money and power at the nexus of banking and policymaking, home of the infamous revolving door in the natural habitat of people like Mike Froman, America's new trade rep, who is shuttled back and forth between government and Citigroup, and who, behind the scenes, helped pick all of Obama's initial economic team. And wherever there's money and power, you're sure to find turmoil. Let me introduce you to the IIF, the Institute of International Finance, but describes itself the most influential global association of financial institutions, whereby influential means it aspires to have the ability to persuade policymakers as to what to do. For most of its existence, it was run by a guy who spent 2 years at JP Morgan before coming the head. He stayed on that job for 20 years. The last numbers we have, he was paid $4 million. That's 20% of the IIS total payroll. Okay, then he was replaced by another guy, another former Treasury replacement. Yeah, exactly, the revolving door. For all this $100 PowerPoint presentation, founder-led, personality-driven enterprise. The presentation, era of rapid change, repositioning, renewals is essentially Adams' buzzword laden manifesto for keeping the IIF relevant. He was a notoriously tyrannical micromanager. The not-so-seeker of career success at the IIF was always to do everything and anything this guy wanted. When he left, his yes men and I had no idea how to react, and the institute rapidly collapsed in a viper pit of political infighting. Philip Suttle has been fired as head of chief of PR. And more worryingly, Bank of America has resigned its membership. There seems to be questions over whether U.S. other big banks might follow suit. That's very bad news for the IIF, which is nothing if it's not a shop where the world's most important policymakers can rub shoulders with senior executives of the world's biggest bank. It doesn't get much more globalist than this, my friends. In recent years, the IIF has also become something of a ham-handed lobbying shop, to the point where a capital markets friendly outlet like Euromoney will happily and openly dismiss its claims as so much self-interested claptrap. I don't get that. The change dates back to the global financial crisis, which caused a massive rise in demands for global financial institutions to be regulated much more assiduously. The institutions fought back through the IIF with a 161-page report detailing the gruesome economic consequences of doing so. A taster, if you take you back to summer of 2010, and Philip Suttle was the guy who was the lead author of the report. He's subtle here, essentially saying that the Basel Committee and others actually did their if the Basel Committee and others actually did their jobs and regulated the banks to the point of which they were significantly less likely to blow up the global economy, then the cost of doing so would be trillions of dollars and millions of jobs. Yeah, as a result, banks don't like being reminded of this report because it's based on the ludicrous assumptions, and partly because the reforms ended up happening anyway. Now, as a result, Suttle got thrown on the bus, although the report came from the institution as a whole. The problem is that the IIF is still trying to have it both. Okay, gotcha. Anyway, so this is what we got here is a globalist take on the world. I guarantee it, never Trumper kind of guy. And certainly, I bet he's not a big fan of Bernie either. I guess, chuckle at that because this is literally what we're dealing with in the world. We got the globalists, all right, and then we got the nationalists. I don't know whether, for all these countries. I mean, you got them in Turkey, you got them in Japan. Is this what's happening right here? And that's always a problem for a globalist and the bankers. Hank Paulson from Bush. What's his name? Geithner from Obama. I mean, all these guys, they're globalists. They take the global first over the domestic concerns. There's just no other way around that. And so because of that, they look at things in the dictates of the old economic school with the Phillips trade and things like that. You pull on this string, this gets tight. You loosen this string, and that gets loose as well. And we just have no validity to any of this stuff right now. And here's my man Phil Suttle. I got no animosity towards him. I just find it funny that the renowned economist tells you what you need to know to make smart decisions for your business in the world's financial markets. I mean, if you're going to say China and the trade deal or whatever Trump was doing trade, I don't care if you like Trump or not, don't care. But if you're going to say that Trumpster was doing something that made China engage in a trade war and that was hurting the global economy, well, what happened differently? I mean, what Trump all of a sudden didn't tweet as much? It's nuts. The issue is we don't know. We don't know what's going to happen. And so what you should do is not worry about any of this crap. Pay off your debt. Save some money. Pay off your debt. Learn how to grow some of your own food so you don't have to be relying on other people to provide it for you. Anyway, I thought that was of interest. Again, I'm sorry I can't read this article to you, but I can't show it to you because I don't subscribe to Wall Street Journal, because when it comes to corporatists and globalists, it doesn't get much more so than WSJ. But The Economist is another one. Ugh. All right, we'll see you next time. Thanks now.